Hey guys, welcome back to the channel. Last week we had a triple witching event, and after doing some research I came across this post that according to their backtesting, they indicated that the triple witching expiration week was very bullish and that the week after expiration was very bearish. So since last week was a triple witching expiration, we're going to go ahead and test this in R. Let's take a look at our script. Alright, so here are some of the packages we're going to require. And triple witching is an event that happens the third Friday of March, June, September, and December. So we're going to do a back test by taking a look at weekly returns for the SPY. But you can do this for any stock or ETF since we're going to be getting data from Yahoo Finance. So let's go ahead and run these two lines. Now we're going to calculate the weekly returns, and that's from Friday to Friday using the adjusted close. So let's go ahead and run line 9. Now that we have our weekly returns, I'm going to separate our data since we only want March, June, September, and December. And we're going to do that by using index month. So we're going to subset each of these months into separate variables. And we're going to do a slight check. So if we take a look at September, we have each September since the start of our data. So here we have 1993 to September 21st, since this week has not yet ended. Now from each of these months, we need to separate and extract the third Friday of each month. For each of these XTS objects, we're going to pass them into this function, and what this function will do is locate the options expiration date. QuantMod has this neat function called options expiry, so that'll extract the location of where we have options expirations. Now we pass that in, and for each of the expirations, we're going to gather the returns 1 week before, the week of, and 1 week later. And for the 1 week later, I wrap this in try. In case the week has not ended, you won't get an error. Rather, if it is one of those weeks, then we're just going to insert NA for the return. After we get the returns for these weeks, we're going to convert this as a data frame. So here I'm merging the index or the date of the options expiry along with the return 1 week prior to the triple witching expiration. I'm going to add the return the week of expiration as a column. Now that we have our data frame, I'm going to rename the columns. So the first column is the options expiration date, and then we have our returns 1 week prior, the week of, and 1 week later. And then finally just return that as a data frame. Since this will get saved as a list for each expiration, I need to row bind my results. So I'm going to use do call r bind, and finally just returning that as a data frame. So let's go ahead and minimize this function. Go ahead and run it. Now we're going to use lapply. I'm going to combine all of my months as a list. We're going to call our function that we just ran, and finally just row bind our results. So here let's run line 51. Let's take a look at our data frame. So here we have our expiration date and our returns. And if we double check for our last row, we have our current triple witching expiration date. Now let's convert this as an XTS object. So we'll go ahead and run line 53. We'll take a look at the returns. Alright, so according to the post, they stated that during the options expiration week, for the most part, tended to be bullish. So as we see from the start of our data until approximately March or June of 2000, that was the case. And then we got a decline afterwards, probably due to the dot-com bubble. And then after hitting our zero line, they started trending back up till at the end of about 2020, where prices are now trending lower. So I'm not sure when they backtested this, but it might have been a few years back. For the most part, it seems that the week of expiration tends to be bullish, except for the current status and the return 1 week later, again seeing declines on the green line up until 2020, where now we're seeing the inverse. So it seems like at options expiration, the returns for the market have been lower, whereas 1 week later, returns have been slightly higher. Couldn't really make too much of 1 week prior. It seems like prices were relatively flat. Now my thinking was that option traders buy positions, and since the market makers have to take the other side, and then after expiration they unload the securities that they use for hedging, as seen in this article. So this is from September 14th, and the triple witching expiration was September 16th. So we see that market makers have been selling equities to hedge their positions. So my thinking was that the dealers were selling equities and then getting out of their positions 1 week later. But if we take a look at the most recent returns, so if we run line 57 and take a look at the console, typically what we've seen is a negative week during options expiration and then a positive the following week, except for this last event where we did see in fact a negative expiration week but now we're sitting negative on this following week. But then again, we did have the Fed increase interest rates this week, pushing equity prices lower, and I would be relatively surprised if we closed up this week. So we'll see what happens on Friday, but just wanted to share these results and the script so that you can calculate and backtest any stocks or ETFs going into these triple witching expirations. So I'll go ahead and leave a link down in the description area to the Patreon where you can find the script. But guys, this concludes the video. Please subscribe to the channel if you haven't done so already. Thank you so much for watching, and I'll see you guys in the next video.